What's up, everybody? Michael Silva here. You are watching the Stock Market Brief Show. Look at what is taking place right now in this current moment. Also took place in 2008, and it also took place in 1999. We're going to be talking about that on today's episode of the Stock Market Brief Show. If you're new here, welcome. Consider subscribing, hitting that thumbs up. This is the show where we use technical analysis and intermarket analysis to get a good idea as to where the market might be headed next. Got a lot to discuss on today's episode, so let's go ahead and get right into it. All right, everybody, welcome back. We're going to start off here looking at bonds and commodities. And what I want to call out here is because we're hearing a lot of talk out there in the macro environment that we might be hitting peak inflation. And if we're hitting peak inflation, it's likely to see the CRB index start to come off and see other commodities start to kind of just back off a little bit. And if that's the case, well, as you can see here, typically when commodities rise, right, bonds fall. But if commodities fall, bonds, they can very well rise. Now, this is interesting because the CRB index is comprised of, well, a basket of commodities, one of them being oil. And oil's really big run-up here has been helping the commodity baskets. And right now, oil is putting in a lower high, but this does look like a compression kind of type pattern, which could very well fire off here in the near future to the upside. If it does not, and we are reaching that peak inflation where oil is going to start backing off, well, guess what that entails? It entails that potentially we're going to start to see the 10-year yield also come down a little bit here, which if you look at from a technical perspective, that's a dark cloud coverage candle, right? We gapped up, we reversed almost the entire move at an area of resistance. We met the full measured move of this inverse head and shoulder coming all the way up to 30, just a little bit above that, which is 3% on the 10-year yield. So if this starts backing off, it's likely to see bonds start to rally. Now, this is where it gets kind of interesting because this actually hasn't happened. This doesn't happen. This type of correlation happens very, very rarely, especially like a 1-for-1. Okay, it happened, like I said, in 2008 and happened in 1999. What am I talking about? Well, typically, okay, when commodities are outperforming bonds, defensive sectors are typically underperforming the S&P 500. So for example, like the purple line right here is commodities and bonds. So in 2020, right, commodities started firing off, bonds started going down. And what does that mean? It means that utilities versus the S&P 500, right here at the same area, started underperforming. Okay, now that is a very interesting thing because the correlation here, that move, while this moves up and this moves down, the correlation is typically negative. Okay, so it spends a lot of time here. We're looking at a monthly time frame. You can see that it's typically below the zero line. Up until recently, we're hitting like a 1-for-1 correlation. Okay, what does that mean? It means that commodities are outperforming bonds. Boom, right here in basically 2022, we're going to call it. Okay, so it's starting at 2022. Bam, commodities are outperforming bonds at the same time that utilities are outperforming the S&P 500. Now you can see this on this specific chart. If you just look at year-to-date performance, XLE, right, that's part of the commodities, right? Well, energy stocks, when oil is doing good, which it is, energy does typically good too, and we're seeing that it's performing very well. But what you're also noticing is defensive sectors leading the charge as well. The only other sectors that are in the green year to date is utilities and consumer staples. So this right here is defensive posturing, and we've been talking about this for a while. But the interesting thing that I wanted to call out here is the correlation is typically never a 1-for-1. And the only times that I look back, that I have the history of this chart going back, it was in 1999 where the market, we all know what happened, the dot-com bust there shortly after, and then also the great financial crisis. Does this mean that we're going to be seeing something very similar? You know, I can't call for a crash. What we've seen recently in this market, okay, is pretty crashy, but I will say that the options market has been pricing this in and it's been sticking to its expected moves via the implied volatility, and we're going to be going into that, okay? Now, how did this week perform? Okay, let's get into the 11 sectors. Well, XLP, consumer staples, was once again leading the way. It was more defensive type sector. And then at the bottom of the list, we have consumer discretionary, financial, and tech. Now, there's a lot of people calling for a stock market bounce to occur. And that makes sense because we've had now 6 consecutive down weeks in the S&P 500. Okay, 6 consecutive down weeks, that does not happen frequently. And if we go back to the 50s, you'll see here, these are the dates right here where that has happened, where we've gotten 6 consecutive down weeks. And then it'll show you the performance 5 days later, 10 days later, 21, and so forth down the list. And what you'll see here is you typically, the next 5 days, typically 100% of the time, you get some sort of positive bounce. Okay, so it seems to me if we're looking into next week, and we'll get into the more technical side of things, you typically get some sort of a bounce. So if we don't, that's going to be interesting too. Now, I will say as you move down the list, 10 days, right, it lowers a little bit. 21 days, it's a pretty strong movement to the upside. It isn't until we get into these areas, 61, 126, where you start to get into some more shaky ground, where you saw like in 2008, we had that financial crisis, right? And then also right here in 2000, okay, you also saw that -3%, -13. We saw the dot-com bust. Now, what is interesting is take a look, right? We've had 6 consecutive down weeks, and that happened right in 2000, okay, and then it also happened in 2008. All right, so I find it very interesting that we're having 6 consecutive down weeks, and then also during that same exact time, boom and boom. So right now, and we're having this very similar type correlation. If we're gonna, history doesn't repeat itself, it often rhymes. But I mean, holy moly, in 63 to 252 days, are we going to see similar performance? And is this 6 consecutive down weeks giving the heads up that, hey, we might be in store for some further more downside? Well, let's hop into the weekly timeframes and get a good idea of what's going on. We've been seeing these sectors break down for quite some time right now. All right, we have a low, we have a high, a lower high, we have low, lower lows, and now we have this nice, Thor hammer candle right here, which definitely looks like we can start to bounce, right? It's been 1, 2, 3, 4, 5, 6 consecutive down weeks. So to see some sort of relief bounce is more than normal, but where can we potentially see it bounce to? That's why we use the expected moves, and we'll get into those here momentarily. So this is the S&P 500, okay? I'm going to get into the more, the levels here momentarily. You can see the Qs are significantly down from a high of just over 400 to around down 290. So we're talking massive damage being done to all of these major indices. Okay, if you didn't know this, right, on the weekly time frame, if you just map out the COVID bottom to the top here, we did come to a 50% retracement level, right? And we're starting to see a little bit of a bounce, but just be mindful that we're still making lower highs and lower lows. So to see some counter trend relief bounce, which by the way, that's why they call it relief bounce, it brings relief to everybody that is trading the market, that's totally normal. If you take a look at IWM, it's also down, roughly from peak to trough so far, around 30%, and this came in to fill darn near close to this previous air pocket gap where we gapped through that in 2020 and started ripping up higher. Okay, and this also did reach to that 50% retracement level too as well, if you take a look here from the COVID low to the top high. So to see some sort of relief bounce, more than normal, but just keep in mind, we still have a lot of trap supply up in these areas right there, and we have wind at our face too as well. So we need to be open for the idea that we're going to start to see some tactical rallies here, but it doesn't necessarily mean that the bottom's in. Everyone's calling for the bottom. They want to call the bottom perfectly. Trust me, the bottoming is a process, just as if the top is a process. The Dow Jones doesn't look nearly as bad from peak to trough, but you can see that we are getting quite a bit of interesting candles building up. We talked about this, how we saw a small body, bigger body, bigger body, bigger, a little bit bigger body right here, and you can see the momentum was picking up to the downside, and it brought us even lower to just almost up, just below 31,500. Okay, so you got to understand we are cracking some very key levels, but we can always get these counter trend rallies, but just understand lower highs, lower lows still equals right now as we stand bear market. Okay, so I want to show you the risk ranges, but I want to show you what is happening from last week to this week. So if we take a look at the SPY, okay, I'm going to click back and forth on these two slides. So watch here. So this is last week's expected move. This is this week. Last week, this week. Last week, this week. Last week, this week. What did you notice? The range is roughly the same size, okay? But we are putting in a lower high and a lower low. So if we are going to get a technical bounce, start looking at 415 to potentially 420. I mean, it could potentially even go higher, right? That means that if we start bouncing up into these areas, that is the upper expected move, okay, for this week. And if we are going to continue the downtrend, this is the area where you'll be looking to take profits from the bounce and or start to realign and look for short positions, right? There's clearly resistance in these areas. There's clearly trapped supply. So a bounce up to here, maybe potentially a little bit outside of it, all right, is more than plausible. But just understand that 68% of the time, price will come back within this channel. And when you look at very liquid products like the SPX, it's sometimes even more than 68% of the time, which we've been noticing. If you notice here, this is very interesting. This is last week, right? Okay, and where did we finish Friday? We finished back in the expected move. We came outside of it, and then we doodled along through it for the week, and then we came right back in. And let me tell you something. When this happened, that day right there, my phone started blowing up. So it was very interesting. When the market got outside of those expected moves, all of a sudden, I had friends and family call me, hey, should we just be, going to cash? And as soon as I heard that and all this stuff, I was like, oh, yep, the market's going to probably be bouncing right now. Makes sense. And 68% of the time, right, even more sometimes, it lands back within this channel. So, it ended up coming back within it. Sometimes it can't, sometimes it's not the case, but it did this time. All right, so now we have a lower high, a lower low on the new expected range here on the S&P 500. It looks like the market after 6 consecutive down weeks, the next 5 days, based off statistics, like previous statistics, 93% of the time, you'll typically be in the green. Okay, one time in the last, last 50 plus years, 70 years or whatever, dating back to the 50s, it was down 0.49%. So that would be interesting data, right? If we had a down week next week too. All right, so keep an eye on that 415 to 420 level going into next week. If you take a look at the 15-minute time frame, price action did get back above that declining 5-day moving average. It actually broke above it, back tested, came back up, okay? So as these days drop off on the 5-day moving average, the longer we stay above it, this will flatten out, which would be nice. Keep in mind, this could be a shoulder, this could be a head, this could come down even further, right? And build out an inverse head and shoulders to fire this back off. But just be mindful that we have this gap right here, we have this gap right here, and then we have obviously the expected move right here at about 415, and that lines up with this volume shelf profile right here, which could very well act as a level of resistance in confluence with all of that. Okay, now I also want to call out the VIX, Volatility Index. The Volatility Index is still relatively high. It is still at around, where did we close at? 28.87. So, can it go higher? A lot of people are saying, well, it's putting in lower highs right now, but the market, is putting in lower lows. So maybe this is a good sign. Okay, maybe, but really, honestly, if you look back further, the VIX is still trending. Okay, it is still trending up. You have a low, you have a higher low, you have a higher low, you have a higher low. Even if it were to come down, fill this gap and come back down to 25, all right, it's not a time to get excited and try to call these bottoms. Volatility is still high. This is where people get chopped up. You need to be very tactical, nimble. You have to be in cash and be patient, or you need to just be a very long-term investor where none of these type of movements actually matter. All right, if you take a look at the Qs, this was last week's expected range, and this is this week's. Last week, this week, last week, this week, last week, this week. What do you see taking place? You see about the same size of range, which means we have just the same amount of volatility that can occur. However, you have a lower high and you have a lower low in the range. So if we start bouncing up, keep in mind that this could be an area of resistance right at around just under 320. So if we get that relief rally or even come outside of it, that is where you'd start to take profits and start to look for short positions. If you take a look at the 15-minute time frame, similar to the SPY, we are still in a declining 5-day moving average, okay, but we saw some strength on the last trading day, gap up, got above the 5-day moving average, back tested it, and we're holding it as it stands right now. We haven't held the 5-day moving average for a little while here. As you can see, the longer we stay above it, this will flatten out. That would be a good sign. It could potentially be forming an inverse head and shoulders to take us back up here, potentially even to this gap up there, okay? So we'd have to look for like maybe a 305 clearing that can take us up a little bit higher, okay? And if you look at the IWM expected move, the risk range, right, from last week to this week, what do you notice? Last week, this week, last week, this week, last week, this week, last week, this week. About the same size of range, but there's also, once again, a lower high and a lower low. So, while you're seeing price action do something very similar, lower highs and lower lows, we're starting to see the ranges. They're still, the volatility is still here given the size of the implied move, the expected move. And then also, it's still sticking within that kind of down trend, or that's getting the lower highs and lower lows in the range too as well. So if we start moving up 185 to 190, those are the areas where you want to start considering taking some profits on the short term, all right? Or, and then play tactically, or potentially start looking for more short opportunities to continue, you play the trend. Weak stocks get weaker, right? Lower highs, produce more lower highs, and lower lows produce more lower lows. Until that changes, we can't really, we can't get excited about a bounce, which what is all we're seeing right now, okay? And what I want to also call out here is when you really dig deep into these bounces, I'm showing you the expected moves here, but look at the bounce, okay? That was a big move, up 3% in a day in the IWM. What do you see happening with volume? Almost no volume. All right, so you're getting a big relief bounce with no volume. What about the Qs? Up, almost no volume. Look at the bounce. Okay, what about the SPY? Up, almost the lowest amount of volume on the week, but it was one of the bigger up days, up 2.39% in a single day. These are huge swings in volatility. So we need to be mindful of that, and we need to be very, very, very careful, okay? IWM on the 15-minute time frame, I want to touch on this really quick. Also could be forming a inverse head and shoulders. What I do find interesting, it held above the 5-day moving average, a little bit higher than both the SPY and the Qs, and we saw a lot of those small cap stocks kind of get squeezed. So we'll see here if we're going to take a little bit of a breather. I'd like it to stay above 176, but even if it doesn't, it's still above that 5-day moving average. So maybe the gap can hold this support, and even if it does were to come down to this gap, right, it still could potentially be an inverse head and shoulders, and we have that upper risk range and a couple gaps above us. All right, let's continue on here, okay? RVX, I guess so. Russell volatility. I think, Russell volatility and both Nasdaq volatility. I don't know if I have Nasdaq volatility chart, but I wanted to call out, they're still in the 30s. So, it's still trending up. So be careful, right? Yeah, we're getting a little bit of relief bounce on low volume, and volatility is still really high. So can it go? Can this drop off and we go a little bit higher? Yeah, sure. But we're still, well above 30 in the volatility index here. Now, a couple of things that can maybe mark off, these, bear market rally or start of a bear market rally is we've been talking about these BP charts. They've been getting overextended, and we've been saying, okay, are we near a bottom? Well, we might be near a bottom, but not maybe the bottom until we look back in hindsight. So yeah, the BP charts extended to the downside. This is the Nasdaq Composite Bullish Percent Index. So yeah, maybe we can get a little bit of relief bounce there. All right, let's continue on to the BP NDX chart. We do have a positive divergence that's playing out right here. So yeah, a little bit of a bounce, maybe get above 50, and then maybe we come up to back to overextended areas. Does that mean we're going to be making all-time highs? No, but hey, we'll be navigating this market, every single day here. BP SPX chart also, positive divergence, right? We talked about getting overextended. Bam, we're starting to see a little bit of relief here, but the market, like I said, it's still lower highs and lower lows. Now, another couple of charts here, if you just look at the percent of stocks above the 50-day and the 200-day on the S&P 500, you can see that they are getting somewhat overextended to the downside. Not quite the 200% of stocks above the 200 or below the 200, but they are starting to get, pretty beaten down to overextended areas. And you'll notice that a little bit stronger here on the NDX. So the Nasdaq 100% of stocks above the 50-day, and then percent of stocks above the 200-day. The numbers getting very low to these low readings. And you can see when we've hit in these low readings prior, they have produced some market bounces and also some bottoms. You can see here, boom, boom, boom. It doesn't happen frequently, but what I will call out is, as the market was rising, we were talking about all the stocks breaking down for quite some time, and it wasn't up until we really started paying attention to the peeking behind the curtain. What was really holding the Nasdaq 100 up, and you can see this because stocks were breaking down, boom, breaking down, but the S&P 500 too as well, right? Boom, it was breaking down while this was firing off. So a lot of the stocks, the internals were holding up, were breaking down, but the only thing holding up the markets were the mega cap stocks. So let's look at the mega cap stocks. The mega cap stocks are they're breaking key levels. They're breaking down right now, okay? And they've been taking significant hits year to date. All right, really quickly, if we take a look at the heat map year to date, this is, Apple down 17%, Microsoft down 22%, Google down 20%, Facebook's down significantly more, Tesla down almost 30%, Amazon 32%. You cannot have a strong market when you have tech, financials, consumer discretionary down like this, okay? And that is what we are seeing now. What's even more important to pay attention to is, yes, we got maybe due for a bear market rally here, but be mindful that, A, we broke a key level. Can we come back test, maybe try to trick some people by coming up and then heading back down? That's Microsoft right there. And what do they all have in common? Well, take a look at Google. Google broke that 2,500 level. Can we come back to back test it? Maybe even get back above it a little bit and trick some more people? Everything's fine. Everything's fine. Let the markets go. And then can it drop again? Absolutely. But just start looking at these levels for areas of resistance. Tesla, right? This was a big warning sign here on earnings. It reported earnings gapped up. Everyone got so excited and it rolled over, which tells me that the big players used that liquidity to dump shares. Then you had Tesla, Elon Musk selling off shares right here, and we got this relief rally, up 5.71% in a single day. But still, when you look at that on this chart, can it come back up to 800, 850, 900? Sure, but there's still trap supply up in this area. Okay, so that was Tesla. NVDA, very same situation. It cracked that 210, 200 level. That is a big crack, which means, can we, a little Morningstar reversal? Can it come right back up here? Maybe we, get up higher? Yeah, absolutely. So that's what we'll be keeping an eye on these next 5 days. Next week, we'll be touching on that. If you take a look at Apple, also, Apple's holding up relatively well. It's kind of just in this channel here. You can see it came down to 140, boom, and we kind of just ping-ponging around in this channel. But there's a lot of volatility. Apple volatility is very high right now, so things are getting chopped up. We're below all these key moving averages, right? Relative strength's dropping a little bit here, but it's rather going flat. So can we get a relief rally, 150, 155? And then if we just put in another, lower high, you'll notice lower lows, boom, 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 and we have lower highs also. So the trend right now, it looks like distribution, and it looks like it could potentially head lower. So we need to be mindful. We need to be careful every single day. And if you look at Amazon, it got destroyed. I'm not even going to show Netflix and Facebook because, well, we already know what's happening. Okay, now this is all happening on the back of a very strong dollar. So a lot of currencies falling apart. The dollar going through the roof. We talked about this bull flag. We broke out, and we've also been talking that this acts almost like a volatility index almost. So this moves straight up, and look what the S&P 500 does. It does the exact opposite. So look at it, broke out here. We talked about that. Can that put pressure on the equity markets? Blah 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 blah, and it did. Okay, so if you can call the dollar's next move, maybe then you'll be very good at calling what's going to be happening next in gold and what's going to be happening next in the S&P 500. If I had to guess, the dollar can be probably backing off here shortly. I would say if it comes down to this 102, 101.50, this zone in here, that is a pullback within an uptrend. So I would be looking to buy that. And if that does happen, S&P 500 could rally up, but also we might be able to see stuff like gold potentially rally up too. And gold right now is now negative on the year. Gold has broke a trend now. It was bullish, so we need to be mindful that it is now below. This blue line is where the year opened up, and we're slightly below. So I would like to see it reclaim these levels. I do think gold, it is still one of the stronger performing assets year to date on a relative basis if we're looking at the SPY, tech stocks, and everything. So it's still a safer place to have money. We're coming into this kind of previous zone of, before we started breaking out here. So it could be all support here. So we'll keep an eye on gold overall. Let's go ahead now and just hop into Bitcoin very quickly. Bitcoin, right? Luna, all this stuff. What a huge sell-off that took place. And, it's very possible that this selling can continue, but it's not going to go down straight in a straight line. I mean, I should never say never, right? Luna did that. And that is incredibly unfortunate of what took place there. And, I don't understand the crypto market, the technology all too well. So a lot, when I hear a lot of people talk about it, they're using this big jargon, these big terms, and I'm just looking at these charts and it's just people get sucked into narratives, unfortunately, and bad things can happen if you're not really focused on managing your risks. So hope everyone can make it out with being okay with this big drop in crypto. It's not a small drop. It's not a joking matter. It was a large amount of money that was completely wiped out in a flash of a second, it felt like. Okay, so if we're looking at the Saylor to Schiff ratio, our indicator did flip down, right? A sell signal. It did break down through that bear flag. There's a strong possibility that we can still continue to head lower, all right? We're getting a little bit of a relief bounce if we look at this daily time frame, right? We had this flush down to around 25,000, and we're starting to see a little bit of a relief bounce right now. But just be mindful of this chart, right? That was a big break, right? You can see a bounce. Like, yeah, even if it went up to 40,000, there is a lot of trap supply right in this area here. So if it comes up, it just be mindful that it can come right back down too, okay? We need to see bases form. We need to get back above these moving averages. We need to see the Saylor to Schiff start to turn up. Maybe that can give us an early indication of a buy signal, maybe a temporary one. It could give us a buy signal in a bear market, right? So it gave us 2 buy signals, I think, this year. One was a whipsaw, lost no money. This one, it actually moved up quite a bit, and I just didn't want to take profits because I was waiting for the next sell signal. The next sell signal came, and it wiped me out a 0.5% loss. So right now on my strategy, I'm down 0.5%. All right. So this has been helping, and if you're holding from the beginning of the year, right, or wherever, obviously down pretty significantly year to date on Bitcoin. Okay, if we take a look at Ethereum found support right here below that 1800, just above 1600 level, and there was prior support, and then prior support up in this area. So big, huge flush to the downside, likely to see some sort of a bounce, okay? But just be mindful that all this can just be a dead cat bounce, and we'll see here if it'll break down further. So be mindful of that. We need to see, like I said, markets, they move between contraction, gets tight, and then expansion, right? As it stands right now, we are in an expanded environment, all right? So price was contracting. It was getting very tight. We were talking about it, and then it expanded to the downside. During periods of expansion is not where you want to get really too aggressive when volatility is very high, because that is also the most dangerous time. You typically want to back into your risk, and by doing that, you need volatility to contract and get tight because it allows you to have a smaller risk available where you can have a stop loss for a potential higher reward. So that's all I got for you on today's episode. It went long, but it was a weekly recap. We went over a lot of data. Hope that helps. Hope you get some insight as to what I'm seeing in the markets, and I'll talk to you all later.